Hello everyone, this is Ryan Sindelar of NinjaTrader. The U.S. markets are now closed and we are glad to see everybody in the room here today. I do want to welcome you all for today's exciting webinar event. And again, this is with Will Shire of Valhalla Futures. So without further ado, I'm going to turn the floor over to Will.
Okay, and thank you for that introduction, Ryan. My name is Will Shire, and I'm Valhalla Futures. My career as a trader got started in the early 80s, so I'm what you call a seasoned trader. I had a professional career in the industry and came up through several brokerage firms, and I got to the rank of vice president of A.G. Edwards. I've trained with people on the floor of the S&P pit, and my mentor was a former trader on the cotton market. So I've ported a lot of floor trader techniques to the screen. I only trade the first hour and a half each day now. But when I first began, I only traded the afternoons instead of the first hour session because I thought the early session was too volatile. I hadn't discovered serial sequent methodology yet, which is the crux of the methods, the Valhalla Future methods that I use. And I found that trading the first hour without it was nearly impossible. But back then, I traded after the initial move and the market was already over. So I skipped that first part of the session. And that way I could get a better feel of what kind of day the trend model was setting up to be. Today I'm going to be showing you the three main day pattern models the market can make on any given day, and also some static time cycles. I presume you're here because you're now trying to figure out how to make a business out of a career out of trading these markets for yourself, like some of us have managed to do. And I'm here to help. I am the author of this book, Pivots, Patterns, and Self-Recognition, but no, it's not available to the public currently, so it's not on the open market. It's just available to the membership of Valhalla Futures and the people who take the course. However, I have carved out what I consider maybe in some ways the most important piece of that book and put it into an ebook. And if you stick around, I'll tell you how you can get it for free. I use my own stuff now, but formerly I have been the diligent student of other brand name concepts, some of which you'd probably be familiar with, at least those people who've been out there for a year or more. Fibonacci, Elliott Wave, Market Profile, the Wysocki School, the Gann School, Price and Time, among 100 others along the way, just to mention a few of the better known ones. But I have to report to you that I was actually unable to make any consistent profits with any of those tools, from the right edge of my video screen, where you have to make a decision, until I uncovered these other concepts of my own. But having said that, my opinion is that real success and consistency actually lies outside methodology, with something you put into practice every day as a trader. More on that later. I have a track record, a performance history. With a track record, you can make judgments about a methodology. Too many online trade analysts and method vendors don't really seem to have a track record. Most of them don't even seem to create a track record. Just trading the first hour and a half every day, I consistently make between 3 and 5 mini Russell points. That's about the equivalent of about 10 ES points if you're more familiar with trading the mini S&P. I do make calls in the mini Dow, the YM, and the mini NASDAQ, the NQ, and the ES. But I do focus mostly on the Russell as the choice, and we'll talk about it a little bit later. I do not use intuition to take any of these trades. I do not use a sort of stream of decision support to figure out which way the market is trying to go in order to take these trades. I trade from specific set of trade setup models that appear each day at the right edge of my video screen. And I take those trades whether I think I know which way the market is going or not. That's real important to distinguish an item to make, because well, we'll get into it a little bit later. If you'd be taking the same trades I do, in other words, just as my students do, if you knew what I was doing. But you could take those trades without knowing what I'm doing, because I call them ahead of their arrival in real time in my trading room. A lot of newcomers come to me and say they have trouble taking my trades, as I call them. It's too emotionally uncomfortable for them because they don't know what it is I'm doing. In some ways, that actually assures me that many of the people who can't take my trades, that I might be doing the right thing. I don't trade with the crowd. More about that later when I tell you how you can get away from the 90% crowd who tend to lose their money. I have student testimonials on the website if you care to read them from students who have actually taken the course. You can read comments from students on my website in a section called Testimonials, those people who have taken my course. And also at the website of a brokerage firm, Interactive Brokers. You see their logo in the bottom left-hand corner, where I'm rated as one of their top educators. You have to look for a place called the IB Marketplace. It's not very easily accessible on their website, in my opinion. And I'm also an educator, of course, for ninjatrader.com. I have a futures trading course and software that goes along with it. I'll be mentioning some of the things in that course along the way, but if you want to read the syllabus and see the pricing and get the details, just go to my website. There's a section there for futures trading course and software. You can read the details there. This is what I'm going to try to do for you today. I call it my deliverables. I want to give you a criteria to judge vendors. People like myself, in this category at least, I'm also a trader, but I'm also a vendor of a particular methodology and the software that goes with it. And I want to give you that for a specific reason because of my recent experiences. I think it might help you decide who might have something to offer you. I'm going to show you how you can look at my performance record, my track record of trades. I want to give you the three main day trade models and discuss what they look like with charts. I also want to show you what I believe is the consistency of profits and why I think the 90% majority fail at it. Although I spoke about this last time in the previous webinar, I'm trying to pound this home because it continues to be, under my observation of those that I coach in between these things, so I talked to quite a few people, that it seems less appealing to traders to do this particular thing that I think is so important, that will make their trading more consistent, than allow themselves to be seduced by a kind of guided intuition, believing they can consistently figure out which way the market is going to go. And that second, there's two kinds of behavior models there. Not trading models, but behavior models. And one of them that they tend to have a tendency to do is more seductive. And it's the opposite model of behavior than the one I'm going to suggest. And I want to give you a free ebook on this subject that I carved out of the larger book, Pivots, Patterns, and Self-Recognition. I've also mentioned, and I'm going to show you how you can get that from me. I also want to show you how you can get some free coaching from me, perhaps on the subject of how to build a trade plan. Don't worry, it's not a hook to sell you other coaching sessions. I don't sell coaching. But we can use Skype to talk one-on-one. If you haven't discovered Skype yet, it's free internet telephony. It's amazing. And I'd like to offer you that as a means to ask questions as well about what you've heard from me today, because we really don't have time to do that otherwise. Your questions are important. There are no stupid questions. I'll explain to you how we can set up a time where you can get some initial coaching and help you get started a little bit later here. And finally, I'm going to give you a way to monitor my trading in real time so that you can actually use on me the criteria that I'm about to give you for judging other vendors. I believe I can teach you to do exactly what I do every day. Not today in this one session, but my course is one lesson per week takes 10 weeks. You can repeat the course as often as you wish. Software that plots the methodology on your charts and builds the support and resistance grid is included in the price of the course. And some of my students actually do better than I do. I think they have a better knack for it in some cases. Like I said before, pricing for the course and more of a syllabus is on the website at valhallafutures.com. Okay, a few words about vendors. I'm spending more time on this because of my experiences recently. When I'm preparing for a series of these webinars I've done the last few months, I went out and sampled a number of vendors, seeing what they were doing, and I was kind of shocked at what else is being presented to beginners, and it made me realize that these people were taking advantage of the experience level of beginners. So I wanted to give you a criteria to judge all vendors, myself included, from a viewpoint from somebody who's actually inside all this and from more experience. Over the last few years, I've learned that the bulk of vendors who are offering your services or software, for instance, are not very good at meeting any real profit goals of their own. In fact, most don't even go near the subject because they don't actually have a track record with any real trade calls made in real time. So let me ask you something. If they don't commit to actual trade call entries using their own tools in real time while you follow along them with your own charts, then why should you spend any of your money and time learning their methods? Now, some do have demonstrable trade tools or techniques, but then they cherry pick the examples. But some seem to just gloss over those examples that don't work. And again, don't commit to following specific trade calls while you monitor them in real time. Some don't even have any specific trade tools at all, except a technique for delivering support and resistance numbers. You know, what's above is resistance and below is support, which they then endow with near magical qualities. And they taunt you with them, with predictions of the market's exact highs and lows. Sometimes they claim that they know this a day in advance. Let me tell you something about this business of taunting you with exact support and resistance numbers. If you don't have a method of determining which trend the market is actually in or reversing to as it unfolds, especially in that erratic, seemingly erratic first hour of the day, knowing in advance what the eventual highs and lows are going to do doesn't do you any good anyway. It's how the market gets to these highs and lows, because it never goes straight to one and then the other, does it? What course it takes throughout the day is far more important than knowing what the potential exact highs and lows could ever be. It's like they seem to they want to be able to say things like, well, we told you so in advance that we were going to get to that number. We never guess. We call the market to the exact tick. We are the professionals. I've actually heard people say that. I can't make that stuff up. Professionals don't go about their trading day assuming they know what the exact high and low of the day is going to be. That would be so naive. Floor brokers would just laugh at you. They're only trying to take pieces of it along the way as it unfolds anyway. Many of them don't stick around the whole day for the final high or low. Many of them only trade the first half of the day or so. And what's professional about not tracking any real trade entry and exit with real trade calls? I mean, don't you actually have to commit to a real entry if you're making the business of trading a profession? So, how do you judge vendors? Well, if they not only have a track record, but can demonstrate that track record in real time as it's being made, with trade calls they actually specify and track, with a clear methodology that can be taught and transferred, then maybe they just might have something to teach you. But remember, they have to be real trade calls, not some general decision support that the person really didn't track and commit to. I mean, he should report a fill price that he's going to track. Okay, it's coming down to this area. I'm going long here, or I'm committing to a long here, or we're calling the trade long here. Something to that effect, minimum. Not as it begins to move away and say, oh, I told you that was support. Or if it moves through it, it'll begin to say, well, we have the next support down, and that was going to be too aggressive. He's always covering his tracks. You see a lot of that. His track record has to be subject to the consequences of managing a real trade with a reasonable stop and a series of exit targets or trailing stop orders. In other words, just as you would have to do, right, with your own real trade commitments. No mushy decision support is acceptable. And no trading on their intuition or their supposed superior experience. because those things like intuition or this false professionalism or their supposed superior experience, they're not transferable to you. You can't take a course on them. They don't appear in any curriculum. So they're not going to do you any good. They're not going to rub off onto you. So beware of vendors who are not tracking exact trades, and when you challenge them on this, they claim that their room, they're the professionals, and what you're doing is just asking a stupid, unprofessional question. That's just double talk. It's just a disguise. Another tip-off is that when someone else in the room suddenly comes forth to agree with them, kind of isolating you and your audacity for even having questioned the vendor on this. Those kind of persons in the room are usually just shills. They're working for the vendor. And they're probably being paid with free service or free membership or, even a part of their fee, even a part of your fee for helping solicit your subscription. And if you ever get a phone call from these other supposed traders who were lurking in their chat room, be careful. You're probably about to get sucked into a scam. Yeah, I'm a bit annoyed by vendors who pull this stuff off. I wouldn't spend so much time on this. I've just experienced lately, and I'm even a little angry about it. I mean, I've talked to so many budding traders over the past months who've been duped by these scam artists that it's like a phenomenon out there, and I'd like to try to, make you guys aware of it. Sometimes the traders I speak to seem almost unable to recover from those experiences. It's like a tragedy. So these guys are out there ruining traders before they even get a chance to succeed. Don't let that happen to you. They ruin it for the rest of us who might actually have something legitimate to offer you. Demonstrable technical tools and specific trade entry pricing. Let that be your guide. And a performance track record that you can tell and that you can actually watch being built. And just so I can demonstrate that I can also walk the walk as well as do the talk now that I've knocked vendors who don't have performance records, here's my own daily track record, and here's how you can read it. It occurs in 3 places that you can get from my website. ValhallaFutures.com. This is the home page, and if you click on performance, a number of years back you can view it's the same format. And if you scroll down, you can see the monthly totals of which contracts that I took in and how much those were per contract every month. I've yet to post September, so I'll be try to keep up. I'll try to post those in a week or so. Most of my trading takes place in the TF contract, which is the mini Russell. That's where I focus most of my trade and my analysis. The least of my trades takes place in the ES contract. And there's a good reason for that. I'll come to that in a second. August was not necessarily very stellar. It tends to be at the low end of what I'm working for. The month before in July tends to be at the higher end of what I'm looking for. I'm only trading with 1 or 2, occasionally 3 contracts. So I don't consider myself a big trader. There is a big difference between these contracts, but I believe it's one of those issues that most traders are unfamiliar with, and what they've learned about it are actually incorrect. The criteria that they judge, for instance, these trades tends to be their prejudice towards the ES. Many vendors feel more comfortable trading the ES. And they give the following reasons. One, for instance, they say that the ES is the leader. It's a market leader. I've heard actually experienced vendors say that. It's absolutely false. The ES tends to be a follower, as does the Dow Jones. The YM contract is the Dow Jones. The NQ contract is the mini NASDAQ. These are all mini contracts. The leader tends to be the Russell and occasionally the NASDAQ. And lately, as we've seen the market reach these heights and be rebuffed, you get what appears to be more leadership out of something like the YM, for instance, as the Russell tends to want to resist or diverge what bullish ground the YM is making. Well, that tends to be a sign of this divergence happening in the larger time frames. So if you looked at a daily chart of the Dow versus a daily chart of the Russell or a lot of other indexes, the daily chart of the Dow versus the transports daily, for instance, you're beginning to see a large divergence, and those tend to be signals of trend change in the larger time frame. It doesn't mean the TF isn't leading. If the YM is making bigger ground to the upside than the TF these days, it might mean that the TF is already peeling off, and its resistance to go higher is in fact a leadership sign. But give it and take that. The ES, the other reason they're trading the ES a lot is because they say it's the most liquid contract. Well, that certainly is true. There are more contracts traded in the ES than any of these contracts. In fact, there's more contracts in the ES than all these contracts put together, plus quite a bit more. That does not necessarily work in your favor. If you're in a single lot of the ES and you're trying to get out at a 2-point profit and it gets up to that point and you're trying to get a fill at that point and there are 4,000 or 5,000 contracts ahead of you trying to get filled, you're at the back of the line. So the ES almost has to trade through your price to get a fill in either direction, either your fill as an entry or your fill as an exit. And if you're unable to get a fill after sitting there at that price level and you try to begin to back off, you may, in fact, emotionally is what we usually do. We try to back off once we see it's not getting filled, or everybody else has seen it's not getting filled, and suddenly the bid and ask is dropped and you're chasing it back down to the next bid and ask, and there's 3,000 in front of you there. You see what's happening. It doesn't necessarily serve you that the ES is that liquid. The mini Russell contract, on the other hand, is plenty liquid enough for small traders. The bidder ask may be 20, 30, 80, 200 contracts at any one time, and you're only trading a few of them. If you're trading 5s or 10s or 15s or even 20s, your orders are going to get snatched up instantly. But they don't always have to trade through your price to get a fill. If I have a 1-point target and it gets up to 1 point, I often get filled at 1 point. And I don't have to chase it down a whole quarter of a point, which is like 3 ticks, in order to get a fill. Why? Because the mini Russell trades in dimes. It trades in tenths. The ES trades in quarters. It's much clunkier. So for many reasons, those reasons alone, I think the TF has advantages to trade. The last issue is, to some traders, a big discouragement. And that is, since it's the leader, it tends to be more volatile. And that is the case. The mini Russell is indeed more volatile than the ES contract. The ES contract is probably the least volatile of all. So that you have to have a fairly precise methodology in order to take advantage of the turns and the production these contracts show you. But I can't tell you how discouraging it is when you've identified a turning point correctly by your methodology and the mini Russell takes off and it's already up 2 or 3 points in the space of a few minutes, which is 3 points is $300, and the ES contract has hardly even moved a point because it's much slower and it may not participate with that particular pullback to the same degree. So if you haven't tried this yet, I'm not suggesting you jump into it with your money, but you should have it on your screen. Compare the two side by side. I have all 4 contracts in one monitor side by side vertically so that I can see them. And if you're still a beginner and you're taking a lot of your trades on a simulator, which is a very smart thing to do to get started with, then be sure to put the mini Russell up and see how it trades. All right, so this is one place you can see my trade performance, but this is all, of course, very past tense. The other place is the daily trade blog, and you can see the trades as they occur one by one. That performance, by the way, farther down that file had these same figures in it that were not totaled by the months. They're totaled by weeks and they're totaled by days in there as well. But this daily trade blog doesn't go very far. It goes back a few days and then I make comments in there occasionally, and then it goes back a couple more weeks. If you get to the bottom, it says even more, and you can get a few more weeks out of there. Very rarely do I write any trade comments, but you can see what I'm shooting for and see what my trades are, and see how many contracts I'm taking. You can see occasionally I take 3. Most of the time I'm taking true. Sometimes I'm taking 1. This is about my trade quota for the day. I'm looking for 4 points in the TF, the mini Russell. I lost 35 points in the YM, but those YM points are only $5 a piece, and the TF is $100 per point. All right, those are this particular summary of my trade, of course, is my daily results. But you can actually see my trades as they're being taken. You can see these coming off with timestamps on them in a real-time trade room. And I'm going to show you how to get into that, and you can get that into that from my website if you have the right link. The link isn't on the website itself. But later on I'll show you how you can get into that. The daily trade blog, the archive, and a real-time chat room, which didn't come up as point number 3. I'll show you how to get into that a little bit later. My track record is pretty consistent. I've had 2 losing days in the last 3 weeks. None of my months so far this year are losing months. And 50 points in the mini Russell is worth $5,000 over the course of a month. And there were, of course, some other trades in the other contracts. I did not start out that way, believe me. I lost money before I learned how to make it, and I used unsuccessfully a set of tools before I found tools that did work for me. But it's the consistency is based on the fact that I have a very specific trade plan that I use every day. Not that I've now developed some sort of untransferable intuitive skills that can determine which way the market's trying to go. And I position it that way because I'd like you to ask yourself this question. If you've already lost $3,000, which is the cost of my software plus the course, it's included for $3,000. If you've lost that much trying to develop or learn or find your way, and in fact you're using your best intuitive skills plus some decision support items like Fibonacci and moving averages and MACD, turn-ups, and all the things that go along with it, but they're not formulated yet in a specific trade plan, or they really can't be formulated in a specific trade plan, will the next $3,000 of risk get you there? If you're already at a trade plan that you can repeat your last $3,000 worth of profit and you're making this consistency or more so, I congratulate you, you're on your way. I don't have much to offer you. But if your next $3,000 might be a loss using the same intuitive skills as you've already learned, then you might consider trying to come up with a trade plan first, or a more exacting methodology that can be converted to a trade plan before you lose the next $3,000. Something for you to think about. Day models. What are we talking about with day models? All the day's price patterns you face, that piece of chaos that you're looking at on your charts, regardless of what time frame you use, it doesn't make any difference. You face this every day, trying to discern or categorize or witness, analyze it according to your current trade tools that you're using. Every one of those price patterns that is unique every single day that you trade can actually be boiled down to just 3 main models. Imagine that. It can accurately be said that there are no 2 days exactly alike, but there are only three price models exhibited by these individual snowflake-like price patterns. I categorize them the following way. Now, other people have done this, but they categorize them in different ways. One is a narrow range day. The other is persistent trend day. And the last is test and reject day. Now, test and reject has a brother called two-sided test and reject. But for purposes of trading and analyzing and looking for the trades, they actually will result in the same sorts of trade choices you'd be making. These models usually provide both long and short trade opportunities. Once you understand how these trade patterns set up, understanding the model often tells you what kind of trades you should be taking. And please note that this concept only gives you a general understanding of the day's trend and day's pattern. In order to fine-tune the right entry levels, I use much more exacting methods than what I'm about to show you, because these are the general scope of the day. I use a serial sequent wave method and a breakaway pivot grid as a price support resistance grid for my exact trade entries. But this is the background to that. And those other things are, of course, taught in the course with the accompanying software. In order to understand these trade models, you have to first start out with something I taught in the previous webinar, and that stems from the opening range. Now, what is the opening range? What you see in front of you has two yellow lines going out horizontally, and that particular bracket is a bracket on the first 1 minute bar of the day. I often use 3 minute bars in the day, but to begin assessing this opening range, my software actually brackets the first 1 minute bar. Well, why 1 minute? The opening range isn't actually 1 minute. It doesn't have anything to do with time at all. The opening range comes from the pit where the large physical contracts are traded. If you ever listen to a Squawk Box, there's a pit barker down there, pit boss, who is calling out the auction market. And his job is to make sure that nobody got missed at one price at a market trade that was legitimate and so forth. So he's calling out the auction market all the time. Orders accumulate overnight. They, of course, have a pre-cash session where you think these orders might be filled, but many orders still come in overnight from customers to be executed at the opening. And they're also looking for a consensus of activity in the volume that comes when the cash market opens. They don't want to get executed in the pre-cash opening. That might be too thin for them. Their order might be too big for that. So they're waiting for the opening of the day to take place. So these are a lot of orders that have accumulated right up until the opening. And when that opening bell occurs, that auction market comes together and those orders get crossed. And it takes 30, 45 seconds usually for those orders to get crossed. And the pit barker then will call out the opening range. Every good floor trader takes out his pencil and his little notepad and writes down what the opening range is for the contract that he happens to be standing in, probably the S&P pit, and writes down what that opening range is. Because those could be the most important numbers of the day. And that's what those numbers are to a floor trader. We live in the electronic world here. We're trading electronic contracts. The one you see in front of you is the YM, which is the mini Dow. And in order to approximate what might be the opening range, I simply use a 1 minute. So I call the opening range bar the ORB. You won't find it in a book anyplace. I had to make that up just as a way to get at the opening range. And you can bracket the first minute of the bar, even if afterwards you go to 3 minutes or 5 minutes or something else in order to trade whatever it is you're trading. You can still bracket the 1 minute bar of the day and let those brackets extend throughout the entire day, because it's from the opening range that we orient our positioning as to what kind of day model we're in. Here you see the market falling off from that initial price. And I've actually taken a real day with some real comments I've taken from my chat room, because I believe this first model is a test and reject of the three models that I want to show you. We're going to start with test and reject. And on this particular day, I believe that my serial sequent was telling me, I think these might be 3-minute bars, but the serial sequent was telling me that I have a buy order, I have a buy signal coming up just lower than this, I believe. Usually the signals are color-coded, but I had to go to the server. The color coding only disappears after a few days, and I have to go out in cyberspace to get these for the seminar. Trade call, and there's those little funny little numbers there that would make these orders come out in, these letters come out in green, or color-coded in green. And I'm buying the YM, the next push down or the next push lower, if it comes, to open a long position. I'm calling that at 9:59, and this is where price is now. So someplace lower, I'm a buyer, and during the day I've already told what my support and resistance numbers are. Or just before I enter the trade, I'm saying what the next support number is. So I'm looking to see how whatever it is right here. Numbers are 105 and 104. It's shorthand for 1305 and 1304. Something lower than the current price, 10, 15 points lower, something like that. I'm looking for some support. And I'll be looking to see what the YM does as it goes down there, and I have a technique for wanting to buy it. So I'm buying that down. Now, why would I be buying this falling market? It's because the test and reject pattern that I'm about to show you occurs on more days than any other day of the month. Out of 21 trading days of the month, prices test some level, whether it be up from the opening or down from the opening, and reject it. Find support, reverse, and come back. It's the most consistent pattern of the day. It's sort of like a big head fake. The other two occur much less frequently. And so immediately I want to get on my side the probabilities that a trade is going to succeed. So I tend to fade the first direction of the day because it usually comes back. It's just that simple. Oh, this is what the color code looks like. This is not even the same day. This was just from yesterday. Okay, well, that's right. I'm using yesterday as an example too, but this is what it looks like on this 9:59 yesterday. I'll get to that example because it's a different trend day category yesterday. I wanted to show you test and reject first, and I reached back a couple weeks to get it. So it would look like this. Buying TF, next push down. If coming to open, next push down means just the next push lower. The next lower price is breaking the current low in its current pushes. I'm also buying the ES or buying the NQ. The signals are coming in all three contracts. It doesn't always happen. And you pick which one it wants. Sometimes I try to call if I see the signals, even though I'm probably focusing on the mini Russell. Doesn't mean everybody would necessarily be doing that. I'll come back to that trade. I'm back to this one. This is the YM. It looks like, did I pick it up? Trade call, buying one. I'm filling one at 107 and a second at 106. Well, if my numbers were 105 and 104, why did I fill there? Well, it's just the technique I use. If the market's spiking down there, I don't know if looks like I could have got the low very precisely if I'd had a limit there this guy, but I don't really know if it's going to shoot through those numbers or not. And my technique of buying is often, as the market falls, to put a buy stop above price. So the market might have started there. That's the closing price of the previous bar. It might have gone down there. My order, since I was looking for this to be support, might have been put above the market with a buy stop rather than at the market with a limit order, because I don't know if it's going to keep going. If it springs back up on me, I'll probably get filled, and that's probably how I got filled here. Just making some comments there. So in any case, what I'm trying to show you is a test and reject pattern, and I'm trying to show you some other things that I'm incorporating into that working. So I'm fading the first trend of the day. Well, this one is a big success. It came right back. But the test and reject pattern that you're seeing is very typical. It happens more often than it fails. And everybody on the floor knows this. But a lot of other traders don't. They get hooked into thinking, okay, it's going down, so we have a down day. But the truth of the matter is, more often than not, the first trend of the direction of the day fails, whether it goes up or whether it goes down. Now, some people interpret this as playing the gap. Well, in this case, there wasn't really much of a gap. The gap was here. That's the close. My open is here, and the market went in the direction of the gap down. This isn't really much of a gap, but a lot of you are familiar with trading gaps because you might probably trade gaps with stocks. The close of something is here, that opens down here. You try to buy it expecting the gap to close. But in this case, it opened here and went much lower. When you're trading in futures world, trading the gap close can be very high risk. May not be for stocks, but the market often goes in the direction of the gap in the futures world. So automatically assuming that the gap is going to close immediately or even close that day is a big assumption indeed. You can't really transfer that technique from stocks to futures very well in my experience. Higher percentages focusing on the opening of the market, forget about yesterday's close because you're a futures trader. In futures world, it's so important that, for instance, if the market had opened down here, if the market had closed from the previous day down here, this is the end of the day. This yellow line is a session from previous day's cash close at 4:15 p.m. This is 9:30 Eastern Standard Time, the opening the following day. Let's assume for what I'm going to explain to you that the close of this day actually occurred down here and price was open and clear up here. So that even as prices were following and you were listening to CNBC, they would tell you, well, the market's up today at the opening, even as prices were falling. Why? Because it's above the previous day's close. A floor trader doesn't think of it that way. Floor trader doesn't care about where yesterday's close was, doesn't think about the number still being up. If the price has fallen below the opening, from the opening, the market's down, not up. He doesn't care about the close. He cares about the opening. So if you're from that school where you think your relative price is to yesterday's close, flush that and start thinking about the opening. And start bracketing that first 1 minute bar in all your contracts as a habit. In this case, the market did return. I don't remember exactly how I played it, but my typical thing would be to dump some on a spike like this in order to pay for the trade. And that might be 10 or 15 points because that allows me to cover my stop on their second contract. It's a real simple technique. That's what I usually do. In the TF, I sometimes do it as little as 5 ticks, which is $50. That'd be 10 points in the YM and 1 point in the ES. So you partial out. You're all familiar to that sort of thing. In this particular setup, however, I didn't know it was going to come back. It's a very key thing now to note that in serial sequent, this particular pattern, let's cut it off, someplace in here before we all know that now that it was coming back, was that my call for this trade would probably be stop and reverse. In this case, let's say I got out of part of it, but for the remaining pieces down here, I would not only get stopped out, but I'd place an order to short if this first leg broke. And this particular day, I believe that's exactly what I did. I called for it, but it wasn't because I thought that it was. I don't make that assumption. I positioned for it in case it might go lower than this first leg, because if it did go a first leg, it could still end up being a test and reject day, but it has 2 legs getting down to it. Not uncommon that the first leg of a test and reject is much deeper than this. So those are 2 parameters of the test and reject. There's often 2 legs, and if there's a second leg, I try to get short and go with it. In this case, I didn't know to get short up here. Too bad that I didn't. Nice trade, getting short here, going long here, and going back up here. So this has parameters for both long and short, and I'm trying to emphasize here that it's not predictive in nature. When I bought this, I couldn't be sure it was going to go back up here. I was playing the probabilities from a support point, and the structure that said this is the first leg for serial sequence said I should be a buyer down here. But as it's formulating here, I have no idea if it's going to have a second leg or not, and I'm willing to go short that it might have a second leg. In this case, it didn't, so my second long is good, and I'm looking to dump when it comes back to where? The beginning. the opening range. A real simple concept here. I've faded the first direction of the day and I've dumped it when it's come back. Now, this same pattern, which repeats itself so much, both whether it goes up or goes down, also gives me another trade. From here, I don't know if the trade is then going to go back down or it's going to break out and continue farther. So usually, depending on what the structure of the wave is, I'm usually selling this when it does come back. And if it pauses and gives me a pattern, this sell point, much like this buy point, is stop and reverse, back to long. See the difference? I'm not predicting. I know what the market's going to do. But at critical junctures, I call sequence of the chaos, I'm positioning for it to go either way. I'm long, but willing to go short if this fails. I'm short, but willing to go long if it continues going. Now, you can't just do that at a random place. It does take a fairly precise understanding of what the chaos pattern is. But just understanding this daily pattern of test and reject against the opening is going to give you a lot more experience of how the day goes. Next day model. We're going to do narrow range day, I guess. Is that what we're doing? We already... persistent trend day. I don't know which one we're going to do next. Probably persistent trend day, because that's the one. I didn't have those in the same order as I did before. It looked confusing. Apologies. Looks like we're going to do persistent trend day. This was just yesterday. Buying TF the next push lower, ES. So far it looks fairly much the same. I believe I'm using 3-minute bars here. And that means from here down here someplace, I'm a buyer. If it gets down here, I'm a buyer of this first leg down. And any of these contracts. I just typed whichever because I know all my students are thinking the same thing. They've had the experience now. They're not interested in buying the ES or the NQ if they can avoid it. So if they get a signal, they're buying the TF. But that's a new thing for you. Buy the next push down, and it's probably stop and reverse, the same parameters, but I'm looking to be a buyer down here. Yesterday, I can't remember what it was. Whichever TF. Okay, there's one TF at 35.3. 35.3. So this was, let's go back up. Oh yeah, I was only right there. That's where I was earlier. And this red spike has occurred. This is a 3-minute bar. So when it broke down to here, all the way down to 34, looks like one fill was at 35.3 and the other was 35.9, and it got all the way to 34. So I didn't buy the bottom here. I didn't know what that tick was. I only know that I had some support there. I'd already called the support, and I was fishing for it in a very similar manner. I got one at 35.3, which is there, and the other one is 35.9. So someplace in there, I was trailing it down with buy stops. It turned around, and I picked them up. That's usually what I do. Or if I do get a support point and I see it stalling, I'll pick up one on a limit order, and I'll try to work sometimes a second order below me to get a second fill, or on a stop above me if it starts running back up. I'm not predicting the market. I'm positioning it. Try to get that sense of difference. I am taking a chance of purchasing down here at the low. And it may be quite contrary to what you've been taught. A very typical thing that you get from, XYZ vendors and all the books that you probably read is you never buy the market when it makes new lows. Tell that to a floor broker. The floor brokers that I know and train with would laugh at me. They're depending on that. They trade from the lows and the highs all day long. That's where the stops are all hiding. The guys that already bought here are putting their stops here. If they're really piling up the stops, that's even a better place because they're trading against the crowd. All right. So not a great fill is my second one. Blah, blah, blah. I got out of 1.4. And stop was 0.1, out 0.2. So as soon as it started moving up, I moved my stop to +1 at some point. It looks like it got all the way up here, and I got out at 0.2. And then it looks like it came back down. So I was trailing my stops, or I took a 2-point target. I sometimes have a 2-point default or a 4-point default when I'm trading 2 points, 2 targets. This is the first trade of the day, and that's really about half the quota I'm looking for. 2.5 points in this trade. I think I already traded the ES earlier. I actually traded the ES yesterday, and it did the same thing I was looking for. It has a different price pattern, and it got to the first leg, And I traded the first leg because the TF didn't give me a leg to trade on, and the ES gave me a deeper leg, and I actually traded 2 contracts, one plus 175, and I think the other one was plus 1. So this is actually the second trade of the day for me, and I've got very close to my quota, and it's 10 minutes after 10. And I'm only trading the first hour and a half every day to get the quota and performance record that you've seen so far. Good call on the second exit there. Well, he's making that comment, but it was just mechanical. I didn't know it was going to stop there or come back. I have no clue. I'm not predictive. I'm positioning. I'm pounding that home because I find new traders think that everything is predictive. It's not predictive. It's positioning around trade models and strategies. Okay, so why this persistent trend day? Well, that means that there is a possibility that this is stop and reverse down here. That is, if this now fails, I'm already out of everything. If I was still long one, my stop wouldn't even be at the low anymore. It certainly started out at the low as this thing was coming back, but now that I'm out of everything, I don't have any stops. But doesn't mean that I wouldn't necessarily reverse the trend in my concept if this breaks, because if it fails now on the first leg, it'll probably do a second leg down. I don't know if it's test and reject yet. Selling TF on breakdown, I've already called it here, someplace at 1021. These are 3-minute bars. So someplace in here, right here, I'm calling further breakdown. I'm going to go short. That's what time it is in 3-minute bars, 10:21. So we've already had, that's 10:15 plus 3 plus 3 plus 3. So I'm up here into the 20s, and I'm saying if it goes farther than here, I'm going to go short. So this is selling TF on breakdown on a stop, or stop and reverse. That means if you happen to still be long, your strategy would be to stop and reverse to open short, to open a short position. Possible double pump. That's a serial sequence term we use with students. It doesn't mean anything to you. And that was up here, and so I'm short from here. Stop T minus 3, just one. I just took one contract. I usually take 2, but I don't know. I chickened out. I only took 1, and as soon as it broke, it started going down. And I put my stop at -3, so I got in there, and my stop is up here, a few ticks away, and it got, for a while there, it came right back to the break, but then it developed on, and I got out it, moved the stop. I'm just moving the stop here. +4, +6, +7, +1, working +2. It got to 1.5. I put a stop in at 1.5, and I got port 2 out of it finally down here. So this is the second leg down. Now this still could be stop and reverse, but it is stretching. I mean, it still could be test and reject, but it really stretched and became, now I'm able to see, extended. I'm now getting big extended bars. I'm not getting some tight things that are still forming here that may spring back. And because of this big extension here, it's becoming less likely that I'm going to bounce up here. It's still possible, and it still could be a trade from down here. And the first trend, these things just come up automatically in the room. Day model assessed. We're going to come back to that end of the first hour and time of day. Well, this is another example of persistent trend day, but it's going in the opposite direction. I just want to give you now some pictures of the outcomes of the day. And this is a persistent trend day. This is a little bit different persistent trend day than the one we just saw, but I'll come back to another model of what that one we just saw. Notice what the opening range looks like, and notice here how the market seems to be struggling to get away from it. I remember trading this day. I didn't have a short signal here because it didn't go far enough, but I did have a buy signal here when it came back. So you do have the trend in 2 places. So it's left the opening range, but it didn't get to a place where I had a sell signal, but it's come back to it. And at this point, I'm a buyer with a stop and reverse if it breaks. It's a real simple concept. I'm a buyer here. Well, there was no stop and reverse. And since I only trade the first trend of the day, this is really a dull market, the first hour and a half. And whatever profit I got out of there might have been my whole profit for the day. But I did come back to trade later in the day because this was a QE day where our friend Bernanke decides whether we're going to have quarterly refinancing, and he tends to come out with that news at 12:30 as opposed to the regular FOMC, which is at 2:15. So I did come back and trade this. But this particular pattern is very, very typical, and we call this a flubber bounce. You remember the old movie from Walt Disney, Flubber? The market often behaves this way around the opening range, whether there's news associated or not. And that is, if it starts out in a congestion pattern, it usually begins to trend not in the first frame, where the congestion is, but in the midday frame. I trade the first frame because the first frame normally doesn't look like this. It's normally the more volatile one. And as the first frame comes to an end, and I call the first frame, by the way, to 11:15, not to be confused with the first hour. The first frame usually comes to an end around 11:15, and if it's been volatile, it then starts to look like this in the midday frame. I'm looking for volatility. I don't want to trade drift. Drift muddles the signals. They don't work as well. The market drifts through you. It takes you a half an hour before you end up getting stopped out of a trade that wouldn't go anywhere. It's just not worth it. So the first part of the day is usually the more volatile, but if it isn't, the volatility tends to shift to the middle of the day. It's just a simple rule to keep in mind. By the way, using serial sequent, I did not buy this because that's the news, and I wasn't predicting the news. I often position in front of the news, but I didn't position in front of this because I did not have a signal to use. If you go to my last seminar, I talk about trading in front of the news, not after the news. I should say, not directly after the news. Once the news has taken place and the market can settle down, I do look for trades. But I don't bracket the market to buy breakouts or sell. I don't do that. Usually because your fill is so bad that it's not worth bracketing. I know some people actually teach that, but I don't think they're real traders. Because if you bought this here with a buy stop there, your fill was that tick on the news announcement. This is the NASDAQ, by the way, so maybe it's 5 points in the NASDAQ, which I guess would be survivable, but I still don't like that bad of fills. I did buy this breakout. Serial Sequent told me that that's a breakout. It's a beautiful breakout, and but I got stopped out as it came back down here, so I didn't get the second piece. Just a trailing stop, and I got knocked out, and too bad for me. I want to come back to this particular figure and note what time of day this is. And that happens to be 2:30. This is Eastern Standard Time, because a combination of time, price, we were able to sell this short. Imagine you watching this occur and seeing somebody call a trade to sell short up here. You'd probably think that they were, displaying some ridiculous ego or being stupid and foolish. But I'm going to show you there's a lot of price to this. I'm going to show you one of the tricks we identified of how that was going to be a potential high at that time of day. Just get the overall pattern. The looping coming back to the ORB, this is a persistent trend. The market never traded below the ORB. This bar that suggests that it's below the ORB is, by our rules, not below the ORB. Even though it jabs below the ORB, the whole bar, both top and bottom, have to be beyond the ORB to say of it that it's above or below the ORB. I don't think any of these bars here were beyond the ORB until that bar. The first one, both a low and a high, were beyond the ORB. This was the first one right there. That's what it looks like from there anyway. Persistent trend day again, but in the down direction. See the market looping back up to the ORB, but can't get through it. And we call this monkey bars. If you ever played in a swing set as a kid, and they've got bars going by here, and you swing until you get to the end. And very often it gets to the third one before it collapses. The one I just showed you was very much the same, except it was from above. And you see this model over and over again. I don't care whether a market opened from the previous day here or the market opened from a close of the previous day up there. I don't care about that. I'm not trading from yesterday's close. I'm trading from yesterday's open. This has given me the model that I understand and can work with. Now we're back to test and reject. The market falls, reverses, comes back to the opening. It's a simple concept. So if I was able to identify a couple of legs here, I might have tried to buy this with a stop and reverse below it. And I actually look for the lows. I'm often able to identify them. Sometimes I'm not. When the market comes back to the ORB, my objective is to sell short with a stop and reverse if it breaks above it. In this case, it looks like it was a good trade. Sometimes they just pause like this as they get ready to break above it, and this is the midday frame, and it takes forever. And you grind the enamel off your teeth waiting for the breakout. So I'm usually shorting as it's returning up here and taking whatever it has to offer that I can try to figure out from that short. But I don't know if it's going to stop here, recapture itself, and break through. But if it does, I'm going to go with it. In this case, if I'd had an order up there, it never would have gotten filled. It's not predictive that it is going to happen and keep going, but the test and reject day has that potential. In this particular case, this was the very next day. So these are 2 days side by side. They opened very similar. They both sold off. They both found homes and support. They both came back to the ORB, but this one, after pausing, broke through it. It's not predictive. You could have gotten back up to here and shorted it and had this happen. When it comes up to there, you don't know any different. You're the trader. You're not predicting, you're positioning. And that's the critical difference. Sometimes you get this that you see here, latched on after it pauses here. So we don't always know what the market's going to do, but we understand from general models what it might do. And we're positioning around those probabilities or possibilities. Both these are test and reject. They have different outcomes of the day. But as a trader, I still approached them basically the same. This is persistent trend. Well, it begins persistent trend, but I don't know if it's persistent trend. It's simply gone one direction. And this in serial sequence, I think these are 3-minute or 5-minute bars. I forgot. I can't remember what this day was. I believe I picked it up because this was test and reject in the opposite direction. We get focused on looking, and we only think these patterns can happen in one direction, but it's the same whether it goes up or whether it goes down. And the market comes back to the ORB, and I'm looking to be a buyer here, because this might, having gone to the ORB, come all the way back up and continue trending. It might pause. I stop and reverse to go short through it. And serial sequence gives me an exact wave count to work with. By the way, it doesn't give me the exact wave count based on what it was yesterday, but based on the eternal structure of the current wave that it's in. It's a calculation. Elliott wave, everything has to be fives. If you're familiar with Elliott wave, that's why I'd never make any money off of it, because everything had to be in 5 waves. Well, the market doesn't occur in 5 waves. It depends on the time frame. Serial sequence organizes and studies the chaos and predicts which number it should turn on, independently of what it was before. It's amazing. Here's a different one, but it's a similar example where the market goes up, comes back to the ORB. Here's this one. It didn't pause and reverse and keep going like the previous, so this ends up being a persistent trend day. Start out like test and reject. Between here and here, it could have easily been test and reject, and maybe it was going to wander here and eventually fall. So you see what I'm doing? I'm positioning around the probabilities of how the market relates to the open. But it doesn't mean that if I bought it here, I knew that I wasn't going to end up being short 10 minutes later on a little pattern here and then crash. It just means I got behind this order and now I got to trail the stop and manage it. Even I don't believe it, maybe. Maybe I'm looking at other things and I just have a trend prejudice that day. It says this is never going to go up here. This is going to do a little dance and crash. I'm not predicting, I'm positioning. Can't say it enough. If you catch yourself predicting, you're basing your trades on what you think the direction of the market is. And that is a form of intuition. It's not a trade plan. It's intuition. In my ebook, there's a section called The Douglas Premise. And so for your homework assignment is to read my ebook. I'll show you how to get it in a little bit. And to look up the Douglas Premise, because it was an eye-opener for me. That's from Mark Douglas, and it isn't. I gave it to him. I used his because I used his words from a tape lecture. It's not really found in any of his books. It's my interpretation of a tape lecture. I knew the guy he used to lecture with in New Orleans, is where I'm from, And so I got a hold of some of his lectures before he had ever written a book. But in any case, the ebook contains this fragment that I attribute to Mark Douglas, and from it are derived corollaries on why I think most people fail and why I think most people lose their money. Really key to read that. Narrow range day, persistent trend day. Oh, narrow range day. We're doing the last first, or the first last. Narrow range day. We haven't covered that before. Okay, what is a narrow range day? A narrow range day tends to want to circle around this. It may reject price and then comes back to it, and it may start to break out and then comes back to it. It doesn't want to go either. In fact, if it does, a certain rule that I give it, sometime during the day, doesn't always occur this late at 12:30, sometimes it occurs in the first 45 minutes, then it's predictive that the market is a narrow range day. And that rule is the following. If it trades below the ORB and above the ORB and then back below the ORB and then it touches it, the day will probably end up the same place it started. Now, that's a lot for it to require, but it sometimes, like I said, only happens in a few minutes. Remember, these price bars aren't below the ORB yet. They're still touching it. So the market is first below the ORB down here. Well, maybe right there is the first bar. So it's already below the ORB, finally right there. But none of these are below or above it. Remember, it has to be both ends of the bar. I think these are 3-minute bars. So I'm below the ORB. I'm actually above the ORB here, but I'm not below the ORB here. I'm still hanging with it. So I've completed part of the requirements there for being below it and there being above it, but I got to get now back below it at some point, because this looks like from here going I've sold off, rejected, come back, and I'm breaking out. But this one has come back below the ORB, and if it kept going back down here, it might be a two-sided test and reject. It's a slight variation of test and reject. I rejected the first wave of the move, and now I'm in a trend. But now I've rejected the second wave of the move, and now I'm back into the original trend and would make new lows. Except for the fact, crashing back to the ORB, I come back to it again. Flip the whole thing around, it's just the same going the other way. Started above the ORB, you come back below the ORB, you get back above the ORB, and then come back and touch it. And that tends to predict that the outcome of the day will end the same place it started. And in your charts, what's this called? All you candlestick lovers? It's called a doji. If you dissect a doji, this is what a doji looks like. It's all based on the opening. Your gap players finally closed. Almost. But you went down first. I don't worry about closing the gap. The trades come long before I worry about closing the gap. So I'm not a gap trader. Narrow range day. Below the ORB, above the ORB, back below the ORB, and touches it. This is the end of the day, so this is all squeezed into one chart here. And this is coming back at the end of the day. Maybe it's got a couple minutes left. I can't see. 16:15. No, it's about done. Doesn't quite get back to the ORB, but it's essentially gone nowhere. Now, why is that of interest? Well, you can trade narrow range days. We saw the persistent trend day where the market bounced a couple of times and then kept going and never came back. Your next door neighbor knows you trade, right? At the end of the day, you're coming into your driveway at the same time. He hears that the Dow Jones had been up 300 points that day. And he says, wow, you must have made a lot of money that day. But the market went straight up. You didn't even know where to get in it. Some of the most frustrating days trading are persistent trend days. Luckily, they're the least occurrence of all the trades that take place. Test and reject is much more common. And narrow range day is not too uncommon. The same guy, your neighbor, comes in the following week and he hears that the Dow Jones was flat today. No trades. And he says, I guess you didn't have such a good day today. But if the market's trading up above it and back below it and coming back to it, then you've actually got a signal that says everything you take is going to come back here. Rather than investing in the outcome of back here, you're trading to the ORB again. And that can be an important thing. You're below it, you're back to it. You're above it, you're back to it. Now I've touched it. So what's probably going to happen from here? I'm probably going to come back to it. What's probably going to back here? I'm probably going to come back to it. What's probably happening from here? I'm probably going to come back to it. So every time I get in an oversold condition, it's going to come back to the ORB. It doesn't want to leave it. And that's what a doji is based on, or a near doji, narrow range day. These tend to be some of the most profitable days I've ever traded. So your neighbor's totally wrong. The big 300 Dow days, I usually don't make very much money on those. I couldn't figure out where to get in. You're trying to short them, you just get killed. Every short gets stopped out. Narrow range day was a cakewalk if you're trading futures. If you're trading stocks, maybe your stock didn't go anywhere. You have to pick a stock, and it may be a dog that day. But your futures contracts are fairly volatile. Narrow range day can be very profitable and manageable and sometimes easier to handle. Time of day cycles. We're running out of time, so I don't have much time. The first hour is 10:30, and I mark that vertically on my charts. A guy like Grant Noble, who's a vendor and has got a couple of books out. He's an old guy. I don't think he's even alive anymore, but he used to watch the 5-minute bar at 10:30 in the grain market, or he liked to trade the grains and the cattles, and he could give an idea of what the rest of the day was going to be like based on what that bar was looking like clearly at the end of the first hour. Get a lot of conclusions about what was going on at the end of the first hour. Sometimes at the end of the first hour, if the market had come back to the opening, you could tell right from there. I don't find that rule to be consistent enough. But at the end of the first hour, I do take note of what kind of trade model we might be in and try to assess that. Take a deep breath. Try to see where the day has gone. Step back for a second. What am I doing? Am I consistent with what I see in that first hour? The second static time cycle is 12 noon. For some reason, if the market is trending and it's making a new low or a new high at noon, it almost always fails. So if you find yourself trying to get in sync with a trend and you're buying a bull breakout and it's noon, I step out of that trade. In fact, I used to come back right around the noon hour just to see where the market was at noon. Not that I'd simply trade because the market was a short if the market was making a new high at noon, but if other things were in place, like a full sequence of chaos pattern or a resistance, and it was breaking out at noon so that things had all come together, yeah, I probably would take the trade. I fade noon hour highs and noon hour lows in general. 2:30 is something they call transition time. A lot of traders used to point to the 3 o'clock time as the time where they thought the market would sort of get back in sync or have an effect because the bond market closes at 3. Well, the bond market used to rule the stock market. But even when it was more important for traders to watch the bond market, I still didn't find that it was very consistent that 3 o'clock would be of significance. But I do notice for some reason that 2:30 is. And I look at 2:30 much like I might look at the noon hour. If other things have come together and the market is making a new high, then I'm looking at 2:30 as a possible top or a possible bottom if the market is trended into a support zone at a full sequence. I don't just use it as a time on its own. That's not enough for me. It's not in my trade plan. The trade plan has a number of different filters, and if it's a model, then I take the trade, and 2:30 can be a contributor to that. This is 10:30. This is 12 o'clock. This is 12 o'clock noon hour high. Doesn't mean that the market can't be above it later on. But we definitely wouldn't want to be buying a new high at noon in general. This is one of those persistent trend days. You tried to short it, you really had a struggle. But you can see at 2:30 there begins a transition. It wasn't necessarily the high of the day. But the market had a midday frame. The first part of the frame was straight up. These are frustrating days. This is a persistent trend day without those early bounces. It just zooms off and it never comes back. This is actually a difficult day to trade. But you do sometimes get a transition at 2:30. If the market has not yet shown some kind of a correction, at 2:30 you'll probably get it. If the market has shown in this midday frame, which I count from anywhere from 11:15 to about 2:30, any place in this midday frame, and it has begun to correct, then it often will finish its correction around 2:30 and revert back to the trend that it started with. If it hasn't, then it'll probably max out at 2:30. Don't ask me why. I have no clue. If the market hasn't been trending, here it is an example right here, and it's been in the midday frame, it had a big day. Now it's rejected that and come back down. And it's gone sideways, unable to decide whether it's going to take the trend back or not. But at 2:30 it's begun to come out of it. So if you're in a congestion period, watch for 2:30 as it nears as a time to break out of it. Persistent trend day, down. Look at the monkey bars, swinging back up. Watch the third attempt, because that's often decisive. Now, sometimes those monkey bars will be right up there at the ORB. This one clearly isn't, but try to think of it as the same concept. Watch that third big push. Here's noon hour. You don't want to short a noon hour low. That was painful. After 10:30, you begin to assess what the first frame is, and so far I can't seem to get much return back to the ORB. It's really struggling. I've just got this congestion pattern here, so it's unlikely that it's going to return back. So I may consider selling this short and trying to get the next leg down. Looks like I got a piece of it and come back on the balance of break even. 2:30. At 2:30 we have a retracement back up, and it's the ideal time to get short in this particular model in any case for a persistent trend day to recur. So we finally got a correction back into this area, and from here it would have been tough to withstand that much of a retracement on your remaining contracts. That would have been a nice exit for the first one or two. If you're still in, that's a tough retracement to face. But nonetheless, 2:30 was a significant time. Oh yeah, this is that persistent trend day. On this particular day, that was the FOM, that's the quarterly earnings, and I didn't buy it there. I didn't know better. I did get a small breakout there. I didn't get a lot of it because I got stopped out. But at this particular time, there are other factors. It was a full sequence, what we call a full sequence. There was resistance, and I pulled the trigger up here. Why? It was 2:30. Now, this is a choppy decline, and I think I did trade this, and I ended up getting about that much of it. But it was a trade. It was okay. I didn't predict that was going to be the exact high of the day. I had no clue. Who knows? But it was coming together at that particular time, and I was willing to take a risk. And shorting at this particular time, my stop would have been like 3 ticks. I wasn't going to put a lot of money in it, risk. As soon as it got down, I went to a break-even stop and tried to work out of it. Okay, so we have time of day, and we have models. Let's stop a minute and consider why most people lose. First of all, where does that figure come from? Why do you know that 90% of traders step up and lose? Well, the CFTC and the SEC and so forth, they monitor accounts that open, and they monitor them when they close. And most accounts that come into trading close without it making it a go, without succeeding in making it a go. That's a very high and discouraging number, and each of you face being a statistic in that number as a trader. And everybody tries to figure out why. Vendors will tell you because you're not using my methods. Well, not very many people know my methods, but I know that there's a lot of successful traders out there. So they're using something different than I am, but they're being consistent in their trading from day to day. Then whatever we have in common must be outside our methodology. My analysis of that has come from my experience of coaching, because I've been coaching people for a long time. And I began actually coaching and learning about them as traders before I even had most of the stuff I trade with, because I spent so much time as a broker executing trades and getting to know people and being friendly to people and them sharing what their methodologies were. And that's where I picked up with Larry Williams and all these people who have these various methodologies, because I had clients using them. So I dabbled into it too, and then tried to mimic them or watch what they were doing or coach them in some way. and I began to see their trade psychology when they were under pressure, their exiting, their exits, and so forth. A couple of things. One that I've learned over the experience of these years is that one piece of the puzzle or various technical tools are never enough. The search for technical tools is often the quest for most traders. They think that they just find the right magic tool and they're going to be a successful trader. And right now the fad is getting these methods of getting support and resistance numbers. And Fibonacci is a big fad, and Fibonacci clusters, although a lot of people are beginning to see that it doesn't work very well. I don't use it at all anymore. I'm sorry if some of you are big fans of Fibonacci. I know it sounds like magic. You want to have a seminar where everybody comes to it, make the title Secrets of Fibonacci. Oh, everybody will show up. My experience is it's not very good. Sorry. Market profile is a big one now, or has been a few years ago, but I think it's beginning to wane as well. But I can't get a trade plan out of market profile. I think it's just sort of something the way I talk about the market, but I can't get a specific trade plan out of it so that I have a specific nomenclature that says when this, and this occur, I take the trade. I don't care what I think the market is doing, which trend I think it's in, because my opinion, of course, is lousy, and my emotions are probably opposite to the truth. But my trade model works more often than it fails. I'm going to take the trade. And I take that trade whether I like it or not. In fact, that's often a condition of the trade. How do I feel about the trade? Am I comfortable in this trade? Because if I'm really comfortable in it, my recognition and my experience tell me, uh-oh, I feel good about this trade. Emotionally, I'm not afraid of this trade. There's no fear with this trade. I'm probably about to get whacked. Trade with your emotions and you'll probably be wrong most of the time. You're buying at exactly the same place everybody else feels comfortable. Everybody, as my mentor used to say, everybody is always wrong. Talking about the crowd, right? Everybody is always wrong. If everybody was right and nobody was wrong, everybody'd be rich and nobody'd be poor. Everybody, meaning the crowd, they're always wrong. That's why whole schools are built up around contrary opinion. The bulls tend to pile up at the top. As we speak, I think Market Vein, which is a service, has market analysts and news writers, and this is early October, at 70% bullish. And not very many bears out there, which is, what does that tell you? Well, you study those figures, everybody tends to be bullish at the tops and bearish at the bottom. It doesn't give you what data short on it. You can go on for the next month. But you're getting to a place where you're in the crowd. You're looking around and everybody's already long. Who's going to buy now? So you're in a crowd. And the crowd tend to, when it comes to behavior, my experience is that they tend to rely on support and resistance numbers. Or they tend to rely on their specific technical tools, but they're not grouped together in a trade plan. So they have sort of this flowing intuitive analysis using decision support. And they think their decision support is really sexy because they just bought this thing and it's, Fibonacci clusters. Or it's that, this, and the other. But it's never together when specific things happen that you codify it and call that a setup model. And I don't call something a setup model that I haven't seen hundreds of times. Because my trade plan is built in stone. I don't give up something on there until it's just failing like crazy. And I never got on there in the first place just because I saw it happen once. But once it's on there, I take it whether I like it or not. And I re-engineered my stuff, so I tend to be taking trades at places where most people aren't taking them. I do not want to trade with the crowd. It's a terrible zip code to live in. So there's a difference between this intuitive analysis and specific trade models. And what you fall into with intuitive analysis is usually that you've decided what the trend is already, and then you go back to your tools to see if you can find something that will support your desire to take the trade in your direction that you feel you know which way the market is going. Most of the money, I'm about to give you the Douglas premise, Most of the money is lost in the markets. That is lost in the markets is lost by traders who think they know which way the market is supposed to go from here. All right, I'm not going to belabor the point. I don't have time to do it. But I go into it a great deal with detail in this free ebook that I've carved out of my rest of my book. If you just write free ebook on this subject and send me an email, will@valhallafutures.com, I'll send it back to you. Read that ebook. It's more important than all the trade stuff that you'll ever learn, whether from me or from somebody else. And if you can understand the premise and the structure of your own behavior and the world and context in which a trader operates, you're going to be ahead in the game, and you might be able to approach it in a different way. Free coaching session. Don't be afraid of this, because I'm not selling coaching sessions. So this isn't like a tripwire to sell you other coaching sessions, like a psychiatrist might do. I don't work in the afternoons anymore, so I enjoy talking to traders. So I'm glad to offer this. And specifically, I'm not going to give you, my methodology, because that would betray the people who have helped me build it all these years and helped me pay for the code writers to write it and so forth. So my intellectual property remains that way, and that's not what you'd be accessing in coaching. But if you have questions about what you heard today, or you specifically want help in creating your own trade plan, I'd really be glad to help you, because I think that would be a great deal of help. If you don't have Skype yet, by the way, you should get it. All you need is an earphone, earphone microphones, and internet telephony is free. You go to Skype.com and give yourself a nickname, and you can talk to anybody else's computer, and it's like 100% perfect quality. It's amazing. But if you don't, I have one of those unlimited dialing things, so you can just send me chat, free chat or free coaching or something in the subject of your email, or send me your Skype nick, and because I recognize a Skype nick, just say my Skype nick is this. And send that to me at will@valhallafutures.com, and be patient, because I usually get a ton of these, and it takes me a while over the course of a few weeks to get back to people, but we can chat for a bit. I had a mentor when I was beginning. He helped me avoid making a lot of mistakes, wasting a lot of time, losing a lot of money. So that's what this Skype chat is really all about, to try to point you in the right direction. Don't be alone out there as a beginner trader. Try to build a community, and at least let some of that community, not directly, but inadvertently, by communicating with them and exposing yourself a little bit about what you're trying to do, challenge the current place you reside in, mentally and emotionally as a trader. Or stay exactly where you are, but be satisfied with your current results. You will not change results unless you challenge your current comfort zone. And the thing I like to spend most of my time on this in the coaching sessions is how to create a trading plan. And I'd like to help you get started making one. That'd be a good subject to spend a free coaching session on, if you don't already have a concrete, specific trading plan. Because without one, your chances of success are near zero. You are going to be with the crowd who thinks they can figure this out in real time. Now, to get the rest of my performance and to learn that is to see it real time. And I have this chat room that I reserve for members, because we all use the same methodology, and you can attend it for free. All you need to do is the following. Send me your real name, and I've been honest with you. Don't invent something. I just want to deal with real human beings. So send me your real name and your chosen nickname for using in the world, Trader Joe or whatever, and send that to me at will@valhallafutures.com, and I'll send you instructions on how to link in and see my text chat room with those green things, like the letters that come across the board. It'll say, I'm buying the next push down. He goes, okay, this guy's insane, but he's going to buy it next push down, or I'm going to sell it on a break, or I'm going to sell it if it goes up. And you can see me taking trades, and they're all time-stamped. I'm committed to them at that point. You know exactly what I'm doing. I'm trailing with a stop, or I'm getting stopped out, and that's life, and I'm shrugging my shoulders and looking for the next trade, whatever it is. And it goes out there in cyberspace, and the record I can't do anything about it. The record is there, and it becomes part of my performance. And then I post those in my daily blog, and then I add them up and put them in my performance record. And you can see them being made in real time and can decide for yourself whether or not you think the next $3,000 you trade ought to come from your own trading or maybe learning a methodology. Thank you for your time and your patience with me today. And wish you good trading.
And all right, that was Will Shire of Valhalla Futures. Will, that was an excellent presentation. Really appreciate coming in the room here today and being our special guest. And I thought that he definitely hit it out of the park today. So audience and NinjaTrader members and hopefully those that are going to be future NinjaTrader clients that are here for today's presentation, I do want to thank you as well for attending today's event. We always value all of our clients, but thank you so much for attending today and being around for this great event.